I'm Sarah Williamson, and this is Going Long with FCLT Global. On this show, you'll learn what it means to be long-term from the top minds in global business and investing. Leaders from companies and investment organizations join us to discuss how they are leading their teams for the long run on issues including capital allocation, risk management, climate change, and sustainability. To learn more, visit our website at fcltglobal.org.
Today, our guest is Mark Carney. Mark is a vice chair of Brookfield Asset Management, who's a member of FCLT Global and head of ESG and impact fund investing. Mark is an economist and a banker who served as the governor of the Bank of England from 2013 to 2020, and prior to that, as the governor of the Bank of Canada. He's a longtime advocate for sustainability and is currently the United Nations Special Envoy for Climate Action and Finance. His new book, Values, Building a Better World for All, was just released and is available now. So Mark, thank you so much for joining us and welcome.
Thank you, Sarah. Thank you for having me. And thank you for reading the book. I'm looking forward to it.
I really enjoyed it. I have to say that, this book is about, a lot of it's about the intersection of value and values, as you say in the title. And you start with some things on Adam Smith. I'm a student of economics, and I think you quipped that Moral Sentiments and the Wealth of Nations, particularly Wealth of Nations, was the most quoted and least read book in economics. I do remember reading them both, but can you give us a little bit of a thumbnail sketch of the importance of the sentiments or the values side, as well as the better known, perhaps, invisible hand of value, how those two things really go together?
Yeah, well, you're exceptional in many ways, Sarah, and one of them is having read both of those great works. And, I think the point, you appreciate this, and it goes to your life's work in many respects, that Smith's insight, they go together, basically. The insight, if I simplify the insights, and there's many in The Wealth of Nations, but the invisible hand, the power of markets, and but of course to Smith and to those of us who are truly active in markets, it's understand that markets are social conventions. They don't exist in a vacuum. And part of those social conventions are what he termed as moral sentiments. And it's interesting, I'll just take a step back, which, all of Smith's work is about exchange of goods in markets, exchange of goods in language, exchange of esteem and sentiments or viewpoints of what is valuable in society. And he underscores that those moral sentiments are not immutable. In other words, those values can change with time. And so markets, a social construct, that part of that social construct is the values, beliefs of what we think is important. Those can change with time. And if they change with time, they can undercut, or if they go in a positive direction, support the functioning of markets. And one of the things that I try to draw out in the book is there is an element of that which did happen as the pendulum swung too far in the run-up to the global financial crisis. And those social conventions, those moral sentiments that underpin markets, let's say around fairness, responsibility, a sense of responsibility for the system as well as for yourself, as those waned, markets were undercut, and it very much contributed to the crisis. And so the question is, what can we do to reinforce those values so the market can do its job?
So part of this is the values and the market working together. Another part, which of course we focus a lot on, is time horizon. And so you talk a lot in the book about short-term decision-making at the expense of the future or the next generation, which you call the tragedy of the horizon. So we've thought quite a bit about what are the causes of some market failures, such as externalities around carbon and so on, which is not being priced today. And obviously that'll have a cost to future generations. But can you talk a little bit about how we address the human nature question as well, and ways that we can put more value on the future so that we make better decisions today? How do we put this into practice?
Yeah, so great. That's a great way to formulate the question, because there's a few ways that markets can not be aligned with the social, what we value from a societal perspective. And the first is just a market failure that comes with not having externalities. So with respect to climate, tragedy of the commons, and if we can price that externality, then we bring it in. But as you rightly say, Sarah, there's also human nature, and myself and all of us, we're irrationally impatient. We discount the future quite heavily. And a lot of your work has been, well, how do we change that alignment for better outcomes for everyone concerned? And, in my experience, there's some basics, but they're still important. So think about compensation and the structure of compensation. And, you've done a tremendous amount of work on this. And one of the things we did with the financial reforms, as particularly for senior management, is to hold back compensation for up to 7 years in the UK. And actually that can be extended to 10 years for clawbacks of compensation that's actually been paid out. So that brings some of the alignment. Secondly, in some jurisdictions, again in the UK, the senior managers regime, which gives specific responsibilities for the senior manager to align the values, train, provide the support and compliance and others for their employees, so that they're more likely to act in the broader interests. I think the third thing that we have done are doing in the financial sector is stress testing, and I'd appeal particularly to climate stress tests, which are explicitly designed to address the tragedy of the horizon, because they look at a portfolio portfolio today. What will it look like in 10, 20, 30 years time if countries do what they say they intend to do? In other words, implement policies that are consistent with the transition to net zero. And by the way, they also look at what happens if countries do nothing, and then we end up with lots more physical risk. So that brings the future to the present, and it asks the question of banks and insurers and others, particularly of their boards: do you think your strategy is resilient to both of those outcomes? Then they can make their own decisions on that. The other thing I would say is that, and I emphasize in the book, is from a policy perspective. And here I don't mean financial sector policy. I mean, I'll use again the example of climate policy. One of the lessons from central banking and the history of central banking is that if you're credible and predictable about the kind of policy you're going to run, the market will do a lot of work for you. It'll anticipate the moves you'll make down the road, and it makes those easier. So what happens is, we all know, in the bond market will say move up in anticipation of future, bond yields will move up in anticipation of interest rate action. And that provides some of the restraint. On climate policy, and I'll finish on this, if you have predictability, if you have a carbon price path, as they do in Canada, if there's a date certain when you can't sell internal combustion engines, as is the case in the UK and Germany, that pulls forward adjustment to today. The one point I haven't made, but I'll turn back to you for questions, is to underscore, on top of all of these structural measures, there is also a cultural element that can either be there or not, and can reinforce. And the more senior leaders think of themselves as custodians of their institution, as part of a system, the more that horizon extends out. And that's in many ways the toughest to do, because it's learned behavior, and it's built over time.
Yeah, that I think there are clearly differences in culture, attitude at different organizations about their view of legacy, or being a steward of an organization, or passing it on to the next generation. And many of those are cultural or historical, hard to train, but easy to spot. That's one of the things that's interesting.
Yes.
So one of the analogies, one of the things I enjoyed about the book was you used a lot of historical examples, and one of the ones you mentioned was about the Bank of Amsterdam in the 1600s, and sort of the role that different banks had in issuing money, which of course was very different back then. So maybe you could talk, and it goes to this point you're making about credibility, and did they have credibility? And I was thinking about the parallels or the analogies from that time of issuing paper currency against gold or silver, versus today, where we have people who are issuing cryptocurrency against something. So what can we learn from can you tell us a little more about the banks of the past, and what can we learn to apply to the future?
Yeah, it's a fascinating, it's a great analogy, and it's a fascinating time. And one of the things, so just very quick context is, as you know, having read about it, is there's a period of time where there's a series of gold and silver coins around. Some of them are debased, some of them aren't. And it becomes very hard to use those coins for transactions. And what the Bank of Amsterdam does is says, well, bring us your coins and we will give you a bill in exchange for those coins that matches the underlying value of those coins. So we'll do the hard work of figuring out what's real or what's not. We'll weigh it, we'll tell the metal quality, etc. But the bills that are exchanged are supposed to be 1-for-1 for the underlying gold in the coins, those bank bills. And they become a form of, well, they become currency. And this lasts for a century, a good century, because the bank is absolutely rigorous and consistent in only issuing as many bills as it has of gold and silver in its vaults. But then what happens is what happens throughout history is temptation slips in and they start to become a liquidity provider in certain circumstances. So they provide overdrafts, so they're lending more than they actually have. And then they start to actually lend and they end up very exposed to the Dutch East India Company, which started off as a great idea and eventually became overexposed. And the realization that they're not a stable coin, to use the modern term. They're not one-to-one backed. They have these illiquid assets, these big exposures to the Dutch East India Company. And then and the bank bills, the Bank of Amsterdam bills as a form of money just falls apart. And it's a lesson. And when I think about that historical lesson and transport it to the present and think about stable coins and cryptocurrencies is, well, first off, it's not clear in many cases that those who claim to be backed are actually backed. And we had the example of Tether, who said that they were 100% backed by cash. And when they ultimately were forced basically to release their backing, they were anything but. But even if a stable coin today is backed 1-to-1, it needs to be backed not just 1-to-1 with the, let's say it's a US dollar stable coin, 1-to-1 with US dollar asset, but it needs to be maturity matched. And over time, the temptation to run a bit of a mismatch, because you can, make the benefit of an upward sloping yield curve, will be very, very strong. And that, the credibility of the underlying instrument, I think, is suspect. And which is one of the reasons, I'm shortening the story, but maybe too late to shorten the story, but it's one of the reasons why I think that stable coin model at the core of the system is best as a central bank digital currency, because the way to perfectly match in perpetuity a digital currency asset, a stable coin, is to which is a liability. Obviously, a currency is a liability, so that the asset side is matched 1-to-1 with the central bank balance sheet, central bank reserves. But if you're going to do that, it should be the central bank's digital currency, not some private digital currency, which has this privilege. So kind of working back from that history, which shows it can work for a while, but ultimately, and there's many other examples of this, private money gets debased. So to take the innovation of the stable coin and have it at the core of a central bank digital currency is, to me, very attractive.
Yeah, that makes sense. And it's so interesting how people have tried the same idea, whether it's paper or coins or digital. It's always that liquidity mismatch, and it's always just push the edge a little bit. So
yeah,
just
exactly. It's right. Temptation is enormous. Let's put it.
It's enormous. So as you think about cryptocurrency, or maybe blockchain more broadly, what do you think about the long-term capital implications? Is it, it could be just another currency, and it doesn't really affect the way that real companies finance themselves over time. But you made the analogy in your book to nobody said, here comes a smartphone, there goes the taxi industry. So what's the taxi industry of blockchain? Or
I wish I knew.
crypto?
I mean, it's a great question. To some extent, it's unknowable that I didn't see that. Yeah, the smartphone led to Uber and beyond. But what interests me about these innovations, and they are truly innovations, and can lead to, as I just said a moment ago, central bank digital currency, which itself leads to other, opportunities, and hopefully done properly, more competition in the financial sector, greater access, greater financial inclusion, lower cost cross border as well. Where the taxi industry, if I can analogy, probably arises is in the world of distributed finance, the use of smart contracts, which could be used with central bank digital currencies, but are sprouting up with so-called native currencies. So a currency that is dedicated to a certain activity. So think there's examples in wholesale finance and making settlement basically immediate and saving tens of billions of capital costs potentially. That's not very good for central clearing, by the way. So maybe the central clearing in that example is the taxi industry. Remains to be seen. There's powerful centralizing forces in finance. I guess what I'm groping towards, and I don't really know because it's the right question, but almost by definition I wouldn't know because some innovator is going to come up with this. But that world where the ability to track, and again in climate, there's an ability now with smart contracts, a nascent ability, and therefore with currencies to track carbon molecules, to track green electrons, so that that in the latter case, that the power that's supplying your activity is actually green as opposed to a proportion of an overall basket, something that's becoming more important. So it's a fascinating world without question.
We'll keep watching that one and try to figure it out as we go. Coming back to the book, one of the things that you note is some of the issues that arise when we conflate price and value. And sometimes there are things that are very valuable that we don't price. Today, there's a lot of work being done to try to price value. And so sustainability metrics or impact accounting. Do you think it's the right thing to try to price value and get the market to incorporate it? Or is it better not to try to monetize everything and put some, sort of parameters around what the market can do? How far can we take this?
Yeah, it's a fascinating issue, and there's been tremendous advancements in this, from the new UN Sustainable Environmental Account, the SEEA system, to the impact weighted account project, George Seraphim at Harvard and Sir Ronald Cohen that have led, and I think deep insights that are being developed through that. Where, for my way of thinking, the challenge comes from mixing the secular and the sacred, if you will. So fully blending a monetary estimate of a value of a species, for example, with a financial metric, and ending up in a world of one true number. The bottom line P&L having mixed the two, as opposed to looking at what one's trying to do by doing a monetary estimate is to have some degree of comparability between otherwise disparate factors, social, environmental, governance factors. And I think my personal view is keeping that separate from the financial accounts avoids ending up in situations where the various trade-offs and assumptions that have to be made in making those monetary estimates become lost in the add up, mixing conventional financial and these monetary estimates. And I'll say one other thing, that it is hard to and I go through some of this in the book, when it comes to valuing nature, looking at intrinsic value, putting a number on intrinsic value, as opposed to counting nature in its own terms. So just literally the number of species, or within a species, the number of representatives of that species that exist, and tracking that over time, and what that means for natural capital. So, to sum up, I think tremendous innovation there, real contributions, limits to its application, and also stepping back and just looking at the absolutes. The absolute change in, and I gave the example of nature, I could give the example of girls being educated to a certain standard, and consistent with one of the SDGs.
Yeah, I think that search for the one bottom line can get us into some trouble. Another place that we see that a lot is with ESG ratings. Everybody seems to want to have one bottom line, that this company, gets an A and this company gets a C or whatever. But you talk about in your book fundamental analysis of companies' sustainability profiles. And one thing that sort of surprises me is that the market is expecting one answer on ESG somehow, but sort of by definition, the market has multiple answers on everything else about a company. There's a buyer and a seller. They've obviously come to different opinions about the future of that company. So how do we get to agreed facts? We can agree that the metrics look like this, but get away from this idea that everybody has to agree on the outlooks or a judgment about a company, because people will have different investment approaches.
I think it's exceptionally well framed as an issue. So let's do some of the building blocks for the agreed facts and the approaches around the agreed facts. The first is to have consistent sustainability disclosure to the extent possible. And so what we have seen is with the impact management project, with the sustainability standard board, is developing common metrics for sustainability disclosures. That will be the intention. The intention is to start with the TCFD as the base, and then build out from that. And I should say, for those listening, I'm sorry, I started in the middle of the story. This is a proposed board under the auspices of the IFRS. So its application is to potentially 140 countries. So it's quite a critical development. So first, you have a sort of core agreed set of sustainability standards and metrics and disclosure that has as broad as application as possible. Now, to go to the other extreme, though, investors, lenders, stakeholders will monitor and are monitoring an even broader range of metrics than the SSB, the Sustainability Standard Board, will come up with. And so one of the developments, which I think is encouraging, is the ability to have a single company view, a portable data file, which provides all of that information from various sources pulled together through big data, including social media data, which actually provides, in many cases, provides some leading indicators of both positive and negative drivers for company value. So we've got those two levels of building blocks, and then the challenge is, I try to put in the book, and I think, again, Sarah, you framed it right, is as an investor, as a market participant, you then need to make judgments about how you aggregate how you use that information. Are you using an aggregate of somebody else, an ESG provider, a rating provider, if you will, or are you constructing your own based on what you think drives long-term value? In both cases, and I'll finish on this, is you need to invest in understanding how the metrics are constructed, what the weightings are, what is relatively important, how they perform, and how those align with how you see value and value being created over time. Because as the book goes through, and I think people who listen to this, many of them will know, you can get very different outcomes. And if you're, depending on which ESG metric you're using, and if you're just doing it from an algorithmic or black box approach, you're likely to be disappointed.
Yes, I couldn't agree more. And it's also the part of the point of it is to actually change the behavior of the company. So if it's a black box doesn't tend to change company behavior.
Correct.
One thing that does change company behavior is activism. And we've seen a couple of very interesting cases just in the last, few months, almost on two different sides. You mentioned Danone and Emmanuel Faber in your book as a sort of an icon of sustainability, and then they came under some activist pressure. On the other side, Exxon just recently came under some activist pressure from the other side, if you will. So do you think that this is a development that's going to have a big impact, this activism related to sustainability? And does it feel positive or negative as we go forward?
I think it's here. Activism related to sustainability and to broader ESG. And as you said a moment ago, that there will be a range of views on different companies around these factors, whether the view for the long term is paying off or whether it's misguided. And I think as I interpret the Danone situation, obviously I was outside it, I didn't have exposure to it and didn't have the detail, is that the sense of the activists was that the broad strategy was correct, or the direction was correct, in the sense of having that broader purpose and sense of where, particularly in the consumer product space, specifically the food area, what was going to be valued. But the execution, including internally and the alignment internally, was not there, and that was going to affect and was affecting bottom line performance. So it's performance alongside purpose, and its purpose it's integrated in a way that is going to deliver the outcomes. Obviously, in the Exxon case, those who haven't looked at it, I would commend to look at the engine number 1 80-page deck, which goes through the case, and the case is very much about value creation related to a fundamental strategic shift, which is that society is valuing sustainability more, and the strategy was just, in the judgment of the activist, and then I think revealed by the votes for the directors, the judgments by most of the shareholders, was the strategy was inconsistent with this shift in direction towards sustainability, and therefore it was value destroying. And so you had a case of a longer term shift towards sustainability, towards a net zero economy. I'm not saying it's guaranteeing it, but towards that, and a company that had been slow on it, and in the judgment of these shareholders and the judgment of the votes represented with the board. So I think that scrutiny is very much going to be there. And then maybe I'll make one last point to loop it back to something we were saying earlier about thinking about the longer term and what's the responsibility of the board and senior management, let's say, around sustainability. And I do think that at a minimum, if you're on a board, you should be thinking about what if society actually accomplishes what it says it wants. What if we actually are on the path to net zero? How does my strategy, my company strategy, look in that case? Where am I advantaged? Where am I disadvantaged? And then you can put your own weight on that outcome. In other words, do you think the policies will actually be there? Consumer preferences will hold up and move in that direction. But at a minimum, it's a high enough probability that you need to look at that. And you don't want to be in a situation, my last point, I don't think you want to be in a situation where society succeeds and your company fails under those circumstances, or at least you want to be informed about that as you manage going forward.
Right, because there's both a change in, back to Adam Smith, the markets themselves and the value of carbon, for example, but there's also the change in the sentiments and some right. Business behavior that were fine are no longer fine.
I'll just underscore that second point, because the first point, you're absolutely right. The first point is ultimately it's a direct value driver. The second is a question of, I'll simplify it to social license. And does your social license start to be called into question because you're not part of the solution, and in fact you're not even thinking that the solution is possible. You haven't even diligenced how your strategy looks in a world that is moving towards sustainability.
So one of the things that you talked about that I thought was very interesting is what you call divine coincidence, which is this question about, can you do well and do good? Can you do better in your business? And part of this is what you're talking about here, which is thinking about the future and where your business might go and taking those things into account. I've sometimes thought of this as, a three-dimensional risk return impact. So in other words, if you've got an inefficient portfolio, you can move to the efficient frontier and everyone's better off. Yeah. You can think about ESG issues, for example, and take less risk and get a better return. That's all good. But how do you make the distinction between knowing when you have this divine coincidence, when you can actually have your cake and eat it too, if you will, versus when you're really at that efficient frontier, if you will, and you need to make trade-offs. Is that a way to think this through in financial terms?
I think it is. First off, I agree with your framework, and and that's the challenge that investors need to set themselves, and company management needs to set themselves. Are there these opportunities? Are there factors, whether they're environmental or social outcomes, where I can have that impact? I can let's say I'm improving education in my community, and the knock-on effect of that is that's a good in and of itself, but that improves the alignment and the engagement with the company in its community. I get better people as a consequence, but I also get a community that's that is supportive of my activities, and is building towards it, as opposed to a circumstance where they're, I mean, I hate to go back to the biodiversity, but I could have some impact on some species that the market doesn't incorporate in terms of my social license, and it doesn't affect my employees' view of whether or not they want to work there. And really, what I'm faced with is it could be costly for me to affect it. It's the right thing to do, but it could be costly. And if I'm only rational about it, I might be making that judgment from a perspective of what's the probability I have an impact down the road on my social license. And in other words, could it be dynamically material? And I'll make this observation that one of the big issues in sustainability reporting is, if you take the European Union perspective on this, which is the responsibility is not just reporting on issues that are material to enterprise value, things which may have a divine coincidence element to it, my language, not theirs, but also where you have materiality. So they look for double materiality. So if I have a material impact on a social outcome or a material impact on an environmental outcome, even if it doesn't directly affect me, I need to report that under the European rules, or at least that's the spirit. And there's a healthy debate internationally about that. I think last point, I think where it probably lands for now is that it's the enterprise value materiality, which would be the common standard, and that's the basic building block. And then different jurisdictions, which put different weight on that double materiality, will decide whether to layer on top of that. And Europe has made clear what it will do. Not everybody will go in that direction.
Yeah, that's that. I think that this whole building block mindset is such a critical one, because the chance that every country agrees on the same standard is very small, but hopefully we can build these building blocks really well. So one of the issues that you mentioned in your book, and has been very important, is as we do shift towards net zero portfolios and trying to achieve net zero portfolios, sometimes we see people divesting, right? Clearly divesting from brown assets in some way, and it's pretty easy to get credit for that, when you're thinking about how to about a portfolio or a company. But it's also a little tempting to then just sell that asset to somebody who isn't counting or doesn't care, but then the planet itself doesn't change. So you get this sort of shell game. So how do we actually give people credit for decommissioning brown assets or investing in some moonshot technology that perhaps is going to help with climate? How do we do more of encouraging the good behavior, as well as trying to put pressure on companies who perhaps are not showing good behavior?
Yeah, it's a critical question, absolutely critical question, because this is it's an overused phrase. It's the destination clearly matters, but this is a journey, right? And we've just really, I'm going to oversimplify, but we've really only in the last couple of years decided we're properly going to take this journey, as opposed to hope that we're just going to happen upon sustainability. And that means it's a transition, and we need to go. I said to someone the other day, it's like John Dillinger, the U.S. outlaw, used to say that why he was asked the question, why does he rob banks? He was like, well, that's where the money is. well, we need to go to where the emissions are. And in some cases, that is shutting down an activity and getting rid of the emissions. In many other cases, though, it's about investing with existing actors, existing companies, to get their emissions down in order to support that transition. That means that I, as a portfolio, if it's an investment portfolio or a lending portfolio, I may end up in making that loan actually increase my carbon footprint per dollar invested in order to reduce it and reduce it down the road and serve the world. So how do I get credit, or how do I credibly and consistently show that? And really, I think there's two routes, two broad routes that have emerged. Well, there's three routes. There's one which is the sort of ESG type rating, and it's a judgment on the specific company, but I'll set that aside. The second is a taxonomy, and the issue with taxonomies, Europe has a taxonomy. In general, the issue with taxonomies is do they cover a broad enough spectrum that's consistent with the transition? So, if it's just binary, brown and green, we end up in a world where the vest, in order to get to the destination, don't have the journey. But then if you salami slice, 50 shades of green, if you will, who makes those judgments, and how well can that be done? I mean, that's obviously very active debate, and Europe has one approach. The other and the third way of addressing this, which I personally think is quite promising, is looking at portfolio alignment. And so there's work that's being done as part of COP26 through the TCFD with portfolio alignment technologies. And I'll just quickly explain, if I may. There's sort of three ways of doing this. The first is just a simple assessment of, does the company, what proportion of companies let's use an investment portfolio, what proportion of those have net zero plans? Okay, so that just tells me something about whether these companies are part of this journey or not. And obviously the effort would be to increase that proportion over time, so I'm more aligned. The second level of sophistication, going up a notch, is to say, looking at those plans, how do they look relative to benchmarks? And so many will be familiar that there are science-based benchmarks for different sectors. And so how do the assets I own look relative to those benchmarks? How much of a deviation? I'm measuring basically deviation from benchmark. And the third level is then to map those deviations into an implied temperature rise of my portfolio. And look, and as with everything in portfolios, there's lots of technical, nuances and important decisions in executing all this. But the last one gives a sense of, do I have a 2-degree portfolio or not? Surprise, surprise, the market as a whole is about 3.25 to 3.5, depending on what the segment you're in. But that's where we're starting the journey. And so I think the judgment becomes, if I'm starting a journey there, how am I moving towards it as I back companies that are part of the solution? Am I moving towards where they're going? And I left out one very important point, which goes to core of your work, is that those deviations from benchmark, those implied temperature rise, those judgments are made not just on where the company is today, but where it's going to be in 5 years in terms of its emissions. So is it credibly going to have reduced things in 5-7 years because of the investments it's taking today? And if it is, and if that's likely to be the case, then you get credit for it today in terms of your implied temperature rise, your contribution to sustainability. And so I think those are some of the ways that we answer your question. And people have better ideas. That's great. This is exactly, we're all ears, because we really do need to be supporting this type of longer term horizon investing, so that companies today can get the capital they need if they're serious about reducing their emissions.
So it comes back to the Bank of Amsterdam and credibility, right? It's that, are they are people doing, under the hood what it looks like. So
yeah, and it comes back to, there's elements of credibility, but what we're building in that is a little unlike the Bank of Amsterdam, several centuries ago. There's transparency. There's transparency about emissions today. I mean, we're building that data set. There's transparency about what the company's plans are, what the target is, what the deviation, and then of course, if I'm given credit, that I've invested in a steel company who's making an investment for electric arc furnaces to reduce that. We actually have to see the production that comes from those furnaces in order for that to be the case. And if it doesn't come to pass, then I'm going to have to re-rate my portfolio accordingly. And last point, I'm going to end up with an asset that a few years forward, if a few years forward the company hasn't done what it says, all of a sudden my contribution has gone up to planetary warming, and I own an asset that's probably harder to sell because it's less competitive because it hasn't made progress on one of the most important issues.
Right. And I think that investors are increasingly recognizing that, the value of something today is largely dependent on its value in the future. And obviously, if that's there's a different price on carbon or expectation in the market, that actually is beginning to come back to the value today. So that's when that's when discounting actually works. All right, last question for you. So you mentioned COP26. Obviously, you've been working a great deal on this. Many people are pushing to COP26 for creative ideas, new ways of addressing this. So particularly as it relates to the investment world, what are you hoping to see in terms of tangible action coming out of COP26?
Well, I think we're looking to see two things, and thank you again for having me and having the discussion, because you've touched on a number of them which relate to the structure of the system, the plumbing of the system, whether it's climate disclosure, whether it's what we were just talking about, portfolio alignment techniques, other aspects of market infrastructure that help ensure that investors, banks, other financial market participants can take climate change into account. In other words, they have the information, they have the tools for transition finance in order to take climate change into account, and then do what they do best, which is make judgments. And different ones will have different judgments about the pace with which we're going to address this issue, who are going to be the winners, who are going to be the losers, how they want to, how much risk they want to take, et cetera. So first thing is to have that plumbing in place. There's a huge agenda related to that. It's moving forward very positively, and it's concrete, and I think there's a ton of momentum around it. The second thing, though, is to have the best in the financial system committed to net zero and to a gold standard around net zero, which is not just a 2050 target, but interim targets, 2025 as a way station towards the 2030 fair share target. Clear disclosure around carbon footprint, sectoral strategies, all of that. And that's not, people listening might think, well, that sounds ambitious, but we've already assembled a coalition, the Glasgow Financial Alliance for Net Zero. It's the biggest banks, insurers, asset owners, and managers. You're familiar with many of these entities because they think like you, with $70 trillion of balance sheet under management, and we'll look to grow that. But that's the key table that is moving forward. That is the gold standard. So sometimes people hear about greenwashing and who's serious, who's not. Well, if you're in GFANZ, you're serious. That's what the UN says, the Race to Zero says, and that's what we want for COP, is to continue to grow that alliance. And of course, ultimately, what we all want is that the two come together. The plumbing and information of the market supports those entities, backing companies and ideas and investing, including the moonshots you talked about earlier, so that we can move to a more sustainable economy.
Well, it is an ambitious agenda, but it is such a critical one, both for the investment community, the financial community, but also for, the planet and the future generations. So I just, thank you for joining us on the podcast. Thank you for writing the book. I'd also say, for anyone who hasn't listened to your BBC Reith lectures, those are a terrific way to get, a slightly smaller taste of some of this thinking. And again, just thank you for your leadership, your insight, and your ambition in pushing on these things, because that is what we need to do to get where we need to go.
My pleasure, Sarah. Thank you for having me.
Thanks for listening to today's episode of Going Long with FCLT Global. Be sure to hit subscribe to get new episodes every other Monday. To learn more, visit our website at fcltglobal.org.